Thanks for having me, Lex. Hello, Molly. Glad to be here. And yes, I am filling in for Marcus. If you've seen Marcus before, then you probably know that I'm a little bit shorter. I don't have as much hair, and I like to think I'm a little better looking, but don't tell him. Um, I might just have a better joke or two as well if you've been following along with our Coffee with Marcus and Mark show. But I'm happy to be here. And I mean, that was a lot of fun. But I did get the expiry date wrong. I thought that was the last time you take someone to dinner. Yeah, maybe, maybe not. But hey, what I want to do is I want to go ahead and share my screen here and make sure that we're looking at things together because this is all about options, as you know, with the Tradier Option Summit. And just to kind of get a feel for the type of traders that we have here, Luis and Mindsforge, you don't need to answer this one, but I'm just curious. How many of you are beginners where you really haven't traded options before? How many of you are intermediate traders? I know this can vary depending on your definition, but let's say you've been trading options for at least a year. And then for those of you who are more advanced, maybe you've been trading for a couple of years, you know the ins and outs of options. I'm just curious what type of traders we have here because to me, this is a very important approach to trading, one that I love to trade. And one of the key strategies that we focus here when we're trading at Rockwell Trading. Okay, so I see advanced options trader as one response. Okay, probably a little bit on the intermediate to advanced side for this type of summit, which is great. I know that Tradier attracts a lot of more experienced options traders, which is fantastic. Wonderful. Intermediate. Okay. Okay. Well, today, and full disclosure here, Marcus, these are Marcus's slides. He loves baby pictures, and I think they're cute. I think that they work, but he put these slides together, and I'm just running with it. So today, I'm going to share a strategy, and we're going to cover why I love this strategy. I'm going to give maybe 2, 3 real life examples of how I traded this strategy risking money. And then I'm going to share my trading plan, my rules for the strategy. And that's what we're going to do. But first, let's focus on why I love this strategy. And this is where at Rockwell Trading, our goal is to focus on SRC profits. This stands for systematic, repeatable, and consistent profits because it's easy to get distracted where you're chasing that high flyer, something crazy. Maybe GameStop's going crazy, and you think you could capture some of that. Maybe DJT is going crazy. You think you could capture something like that. But for us, that doesn't make sense. It's not repeatable. It's not consistent. It's something that you can't rely on all of the time. And instead, we want to approach the markets and trade a strategy where SRC profits are possible. This stands for systematic, repeatable, and consistent. And I think that the best way to introduce the strategy is to think like this guy here, Warren Buffett. If you don't find a way to make money while you sleep, you will work until you die. And they say that when you're successful, the number one thing to do is to keep your secrets to yourself. The number two is, okay, well, I'm going to share a secret or two. But, this is actually a strategy that Warren Buffett has used. And I think, why not follow one of the greatest investors of all time? You should all know who Warren Buffett is. But if you don't, he has led Berkshire Hathaway. And look at this stock going back just decades. What a performance. I mean, this is the type of company that is the epitome of success. And he's just been a successful investor. But there are a few secrets or tips that I think we can learn from him. When I first got started with trading, I actually, in 1996, I was an intern for a brokerage that was at the time Dean Witter Reynolds. And it became Morgan Stanley Dean Witter at one point. I was actually in the Sacramento office, but the movie The Pursuit of Happiness was a Dean Witter office in San Francisco, not too far away. And I got started at the brokerage. And I remember the broker that I was working for, he said, my goal is just to own 100 shares of Berkshire Hathaway. Now, back then, it was still a nice little retirement plan, but gosh, if you invested in Berkshire Hathaway in 1996, when I first got interested in investing and trading, you would have done pretty well for yourself just being in Berkshire Hathaway. So this guy, he knows a thing or two, right? The S&P 500 has performed 4.3.5%, and the Berkshire Hathaway, their A shares, actually have definitely outperformed the market. So pretty smart, right? And this is where there's all of these little articles, but you might miss that there are a few secrets, a few tips, a few things that Berkshire Hathaway and Warren Buffett does. And here you see, if you really want to be rich, use these 3 Warren Buffett trading techniques that nobody ever talks about. Well, I'm going to talk about it today. And this is selling put options. So you know that Warren Buffett wants to buy shares and that he's an investor and he thinks long term, but there's definitely an opportunity out there to be an option seller. So we're getting paid, we're collecting premium, we're taking advantage of a situation where they say that options are typically expiring worthless, whether or not that's because they're closing before or expiring at expiration. The bottom line is that, as you know, theta or time decay, collecting that premium, getting paid, that's a nice way to be profitable in the options market. And this is something that Warren Buffett has done. Here, another article, this naked investment strategy helped Warren Buffett make millions. And this is a perfect example. Years ago, when Coca-Cola was around $39, Warren Buffett sold 50,000 put options with a strike price of $35, making $1.50 per share, where he collected $7.5 million waiting to buy shares of Coca-Cola. So if those options were exercised, if those puts expired in the money, then he'd be the proud owner of Coca-Cola at $35 a share, but he got to keep that $7.5 million no matter what. That sounds like a great deal to me, and this is how I like to trade. So we get paid to buy stocks at a discount, right? Not too bad. I also like to think of it as getting paid a dividend up front, right? Uh, if you get paid a dividend before you ever even own those shares, that's not too bad when it comes to trading. So let's talk about the strategy. What is it? Well, we like to trade the wheel strategy. And with this strategy, we start by selling put options. So we're an option seller, we're collecting premium. And with a put option, we have a strike and we have an expiration. And if we sell a put and the stock is below that strike at expiration, then we are obligated or committed to buy shares at that price. But I'm figuring that out before I ever put the trade on. I'm saying this is a price I want to buy that stock at. So why not get paid to buy shares? And this is step one. Now, a stock can go up, down, or sideways, as we know. I actually like to say that stocks move in 5 different ways. A stock can go nowhere, right? That's one way. A stock can go up a little bit. So a minor uptrend. A stock can have a major uptrend where it makes a substantial move higher. And a stock can have a minor downtrend, so a minor move lower, small move lower, or a major downtrend, a major move lower. Now, if you sell a put out of the money, so a little bit below where the stock's trading at, then you're actually putting yourself in a situation where you could be profitable 4 out of 5 times or 80% of the time, right? Because if you sell a put below the market that's out of the money, if the stock goes nowhere, you collect that premium, you've made money on the trade. If the stock moves up a little bit, you've collected that premium, you make money on the trade. If the stock has this huge move, you still make that money, it's still profitable. Now, maybe another approach or strategy would have helped you capitalize on that big move higher, but it's still a winning trade. And then a minor move lower, you could still make money and be right. When there's a bigger drop, that's the last scenario, and one that we don't really want to have happen with the wheel strategy, but because we're picking a stock that we want to own to begin with, we're okay with that. So step two with the wheel is getting assigned, taking ownership. And this is where we are now the proud owners of shares that we wanted to own anyway. And to get assigned, it traded lower than it was when we decided that we wanted to own shares. So not too bad. We're able to buy shares at a discount. Step number three, selling calls. Once we take ownership, once we own those shares, we want to get paid again. The stock could go sideways, it could go up a little bit, it could drop a little bit, doesn't matter to us. We're looking to sell call options now to collect premium to get paid, and the wheel goes round and round. So that's what we're looking to do. That's the strategy in a nutshell. But what I want to do is go through some examples and also show my trading plan so you can really see how this works and what I'm looking for. My plan very similar to Marcus's when we are trading this strategy. So let me jump over to the software that we've developed here at Rockwell Trading. And I've actually been working with Marcus since 2006. I started stock trading in the late 90s and really got interested in options in the early 2000s when I realized that the dot-gone era had come to an end and options were a nice way to capitalize on market movement. I came across Rockwell Trading in 2005 when it first got started, and a year later, after working with Marcus for a while, he asked me to join the team, and I've been head coach at Rockwell Trading ever since, working on strategy development, also helping Marcus from a coaching perspective with our mastermind program where I work one-on-one, and also provide some insights into the strategies that we use here at Rockwell Trading. So we're going to focus on the wheel. And what I want to do is I'm going to show a couple examples. And Oxy to me is just a fantastic stock to trade the wheel strategy with. So with Oxy, this stock just trades in these nice ranges. And you see here, speaking of Warren Buffett, right? When Warren Buffett started to invest shares, or Berkshire Hathaway started to buy shares and pick up shares of Oxy, they have to file the shares that they've purchased with a 13F filing. And once that became known, everybody got excited and jumped on the bandwagon. This is where you see this huge spike in volume and this rally. This is the Berkshire Hathaway effect, or the Warren Buffett effect. So this propelled this stock higher. Once it started to find these ranges and some nice support here, I was excited about trading this one. I traded it in 2022. I traded it in 2023. But instead of buying at these higher prices, I decided on every dip that I wanted to sell puts. I wanted to sell puts. I sold puts at 57, 56, 58. I believe I sold it at 59. I know Marcus did. Every time it would come down to these levels with a wheel strategy, I'm looking at that stock continuing to move sideways or slightly higher so I can get paid. And then if the stock falls more, I'm getting signed shares. I'm taking ownership. I'm buying shares. I have an obligation to do so at that strike that I've sold. And then as the stock starts to move higher, I'm looking to sell calls. So this is a stock that we've traded over and over, and I just wanted to give it as an example, but let's look at some other specific trades and stocks that we have traded. And one recently has been Apple. So Apple, I think, is another great way or a stock that is a great candidate for the wheel strategy, right? Is Apple going to go to the moon? Probably not. Can it rally? Sure. Is it going to go bankrupt? No, at least not anytime soon. Can there be pullbacks along the way? Yes. And this is where once we start to see a nice range here, I'm all over it. I want to trade it. And so when I looked at this chart here, I was interested, especially once we broke down around the 180 level. I wanted to own shares at 167.50, and I was selling puts at 167.50. So this is a situation where actually before earnings here, right? Because after earnings, you look at that pop and, it's always easy in hindsight to say, oh, Apple, of course it's going to move higher and I'm the best trader in the world because I bought Apple. Well, I have a plan where I'm looking for systematic, repeatable, and consistent profits. And here, when we broke down to these levels, I sold puts a couple of times at 167.50. But here, I I want to look at this particular trade. Actually, so on March 5th, we could use this as an example. March 5th was a day where I sold the 167.50 put, collected 70 cents. And that was good for just a couple of days. It expired worthless. So on March 8th, it expired worthless. Stock closed above 167.50, and I have a 3-day trade where I have made money and I'm done with that trade. So I collected all of that premium, and that was step one. Now, did we go to step two? Was I assigned? No. The stock did not close below 167.50, where I decided I wanted to be a buyer. And instead, I got paid. If the stock dropped below 167.50, I own shares at 167.50. But as long as we stay above 167.50, then that option expires worthless, and I look to start the wheel again. So we did not move on to step two in this first example. And then on March 25th here, March 25th, let's move on. So we started to find this range here, maybe between 170, 177.50. And then on March 25th, I sold puts again. I sold the 167.50 again. I got 85 cents. And here, this was the March 28th expiration. This is March 28th. The stock closed at 171.48. I've made a commitment to buy shares at 167.50 by selling that 167.50 put. This time, this expired worthless. No, I'm sorry. Take it back. The first time it expired worthless, I bought these shares back at 7 cents. I sold them for 85. I bought it back for 7 cents. And I'll show my trading plan and my rules. But if I can close that trade for 90% of the max profit potential, I'm going to go ahead and do that. So if the stock drops lower, I have another opportunity to put on another trade. That's what I did in this example. All right, so April 1st. Here, stock's hitting 170. It's sitting around here, and I am interested in owning shares at 170 now. The reason why I wanted to own shares at 167.50 before was that we were moving lower, and looking at this chart, we had this zone of support here, looking back at prior levels where there was less selling pressure and the stock started to rally. So I was a little more conservative at 167.50. But once we started to see a lot of trading around this 170 level, I was interested in owning shares at 170 because there was a lot of trading here. And here we have this indicator in our chart, which we call the lowest close indicator. This is a reference for potential support. On April 1st, I sold the April 5th expiration, the 170, which is here, and we closed at 169.58. So I had a commitment to buy shares at 170. I was assigned. So step one, sell a put. Step two, get assigned or don't get assigned. First time I didn't get assigned. Here I'm getting assigned. I now own shares at 170. And then on Monday, we open up at 169, $1 below where I own shares. And on Monday, April 8th, I'm able to sell those 170 calls for $1.42. Now, this is a lot of premium for just being in a trade for a week. And you see here, did I know that this spike was going to happen? No, I didn't know if we'll get a 4% move to the upside, 1% move to the upside, 1% down to the downside. But what I do know is that $1.42 that I said I wanted to take, and with an obligation now to sell shares, because if we're selling calls, we have an obligation to sell shares at the strike that we've sold. When we're selling puts, we have an obligation to buy shares at the strike that we've sold. And here with step three, sell calls, there was a rally. And at the end of the week, we closed above 170. my shares were called away. So here started with selling a put and then step one coming to an end, repeating step one, selling a put. On the second trade, I sold a put based on my plan. So much of the premium had disappeared that it made sense to buy it back at 92% of the max profit, and then went back to step one. Then I sold a put again. I was assigned at 170. So step two, was I assigned? Yes. I move on to step three. That's sell calls. I decided to sell 170 calls because we were trading below the assignment price that I had, and that 142 was a real nice ROI for me. We'll talk a little bit about ROI and what I'm looking for in the plan. And then step three, if I sell calls and I get called away, I go back to step one again. And that's what I did. Going back to step one on April 16th, I went back, and on April 16th, there was a little more volatility here in the market. And also we're starting to establish another low here around 167.50. So I actually went back to the 167.50, said, hey, let's sell this. I got 85 cents for step one. And then at the end of the week, this was April 19th. April 19th, the stock dropped. Oh no, on April 19th, it was trading at $1.65. So at this point in time, had I just bought shares for $1.70 on March 5th, I would be losing money. I would be losing $5 a share if I just bought shares. Instead, I sold puts 4 times. I sold calls once. I collected all of this premium, 70 cents the first time, 77 cents the second time, $1.42 on those calls. I actually got $1.50 on the 170s, and then I got 85 cents on this. So even though it's trading at $1.65, I'm making money even though the stocks drop. Well, we get assigned, and I sell those 167.50 calls again now for $1.30. I'm getting paid. And then the stock starts to do this. Well, I have a situation where at the end of the week, it is possible for me to actually roll those calls, meaning that I'm buying back the short calls and selling a week later. And I would have been able to get $2.20, collect all of that premium. But we were going into earnings. So for me and my plan, I really prefer not to hold trades into earnings because to me, earnings are more of a binary event, which are less predictable. Yes, we could look at what's happened in the past. We could look at expected moves and what options are pricing in as the potential for the stock to move based on what options traders are betting. But for me personally, I would rather avoid that earnings risk, get out, have a guaranteed profit. And if the stock rallies, no big deal. If the stock drops, then I'll do the wheel again, right? Instead of holding in to earnings and having this extra risk, I'll just sell puts again if I can at these lower levels. In this case, Apple Gap Tire. Marcus, since Marcus and I work together, he played this a little bit differently. I like the way he played it, but it just goes to show that you can have different plans and you could have a different risk tolerance and trade the same strategy. He actually sold the 172.50 calls on this pop. So I sold the 167.50. I still had an opportunity to roll. He sold the 172.50 calls that were expiring Friday after earnings. So there was all of that volatility priced into those calls. I think he got $3.10 and also had the opportunity to make $5 on the stock because he was assigned at the same price I was at 167.50. And this turned into a beautiful trade for him without having a whole lot of earning. Well, he had earnings exposure, but he had so much premium priced in that if you take your cost basis, the price you bought shares at 167.50 and subtract all of the premium that was collected up until that point, I want to say that his break even on the trade was about 160. So he could lose about $7.50 and still be making money because of the wheel strategy. And this is what we like to do to put the odds in our favor, right? We never know if a stock's really going to move up, down, or sideways, but we know that if we're trading these high quality stocks, that they're more likely to have more or less significant moves to the downside, but give us this nice premium potential where we could be option sellers and make money by selling options, but then also make some money by owning shares of stock. So I want to share my plan here because we could talk all about where I got in, where I got out, but I want to share exactly what my rules are. And so in PowerX Optimizer, we have a scanner that is searching for trades based on my rules and how I trade the strategy. And let me go ahead and go over here because I have my trading plan written down here. Let me zoom in a little bit. And let's talk about the actual rules. So, stock selection. I like to trade stocks. So, there's really two components when we're trading the wheel strategy. There's the stock side and there's the option side, right? Because I don't want to trade the option unless I like the stock. With some option strategies, you're just focusing on the option itself, right? The premium, the volatility, the all of the pricing components of that option, and that's dictating what you trade. Here, I need to be comfortable with the stock. So I need to analyze both the stock and both the option. That's where the scanner helps me out in finding opportunities. But from a stock perspective, I don't want to trade stocks less than $15. I don't find that there's really nice premium there. And what I wanted a little more meat on the bone. I also don't trade Chinese stocks. And this is because we're always going to have economic risk where there's something that happens in the market and we have some exposure. That's part of trading. We're going to risk money for the potential reward that we're after, of course. But with Chinese stocks, I believe not only do you have economic risk, but you also have political risk where overnight you could see a substantial move in a particular stock because of a government decision. So to avoid that situation, I think it was go to education where the Chinese government just decided that education companies were no longer able to be for-profit companies. They had to become nonprofit, and you lose like 80% of the stock's value overnight. Sure, there could be something weird that happens in the US as well, but it's more likely to take place in China. So that is why I have no Chinese stocks as a rule. I also do not like to trade leveraged ETFs. Leveraged ETFs have some great premium on the option side, but we could be blinded by premium where our focus is just on how much we could make on the option without thinking about the risk on the stock side. So that's something for me that's a little too aggressive. I also stay away from biotech stocks. We know that biotech stocks can have these great moves, but they could move significantly to the upside and downside. I don't want a situation where I'm in a position and then there's some stage 3 clinical trial and some stock just takes a dump because the phase 3 trials were horrible and the whole company is based on the success of this one product. That's not what I want exposure to. I also don't trade crazy stocks or meme stocks with huge out-of-touch rallies. This to me is defined as 100% gains in weeks or months that cannot be sustained. Examples would be GME, AMC, DJT. I don't want to sell calls on these companies. I don't want to sell puts on these companies. I would rather trade something like Apple, something like Oxy, something like GDXJ, where we have more stability for those SRC profits. Company fundamentals, again, on the stock side, I want to make sure it's a quality company. And this is where I look for stocks that have a PE ratio less than 100. Now, the S&P average is about 25, and that's typically what I go for. But I like to have just a little more that I could analyze and look at in case there are certain sectors where there are higher PE ratios because of the sector or industry, and it's normal for that sector to have a slightly higher PE ratio because sometimes it varies from sector to sector, industry to industry. I also prefer a stock that pays a dividend. So if I'm in a stock and we get below the assignment price and I can't sell calls, I'm still getting paid. Right now, I'm in a UPS position and I've been collecting dividends on that. I'm comfortable with the position and holding it, and I'm getting paid with a dividend. I don't need the company to pay a dividend, but it's a nice bonus. And for me, if it doesn't pay a dividend, then all of my other criteria must look really good. I also prefer that it's a profitable company. And for me, its net income being positive 4 out of the last 5 years and 4 out of the last 5 quarters. So there's the short-term trend where we have positive net income. It's a profitable company because especially in a higher interest rate environment, a profitable company is usually going to be stable, where a company that does not make any money and is not profitable, yes, you're trading based on future earnings, but then if you have a lot of higher rates that are just cannibalizing the profit potential of a company and it has the risk of going bankrupt, that's not something that I want to trade. I also look at correlations. And so I would rather trade stocks that are less correlated. And this is something that I can look at with our correlation tool. From a chart perspective, I want to trade stocks that are sideways or slightly higher with clear support, like I showed with Oxy and also Apple. And then from an earnings perspective, I do not like to trade stocks going into earnings, but I will take an earnings play where there's an overreaction to earnings and it still meets the criteria that I just mentioned, but you have this negative quarter, you have this overreaction, and there's still strong support. I'll definitely trade that. Now, when it comes to options, I only trade stocks with weekly options. In my opinion, it doesn't make sense to go out a month or more because I don't know what's going to happen in a month. It's hard enough to guess what's going to happen in 1 week. So I want to focus on something that's more consistent for me. And in the long run, I see there's more profit potential trading weeklies with less risk. This is where, from an earnings perspective, I don't sell puts unless there are at least 2 expirations before earnings. And then I'm typically looking at this week's expiration on Friday, Monday, and Tuesday. And then on Wednesday, Thursday, and Friday, I'm looking at this week's expiration and next week's expiration. So I'm only going out potentially 2 weeks max when it comes to the expiration. The bottom line, is it a stock that I want to own? Is it a strike I want to own the stock at? And if I'm not comfortable potentially owning a company for 3 to 6 months, if things do not go as expected, I don't want to take the trade, right? When I sold puts on Apple, I was totally okay owning shares of Apple for 6 months. It wouldn't have bothered me in any way. And if the stock moved lower, I'd be totally comfortable picking up more shares at a lower price. If I loved it at 167.50, I'd absolutely love it at 150, right? As far as puts go, I sell a put when the strike is at or below support, which is that lowest close level. And that's easy to see visually with the chart, but we have an indicator in PowerX Optimizer. If the VIX is really low, I might go a little bit above that level. If the VIX is high, I definitely want to be at or below. Option premium. This is where I like to see that I could get 30% returns based on the premium I collected for the period that I'm holding that option or I have that exposure. If it gets too crazy, I want to check the news to make sure I'm not missing something out there. On calls, I sell calls at my assignment price or cost basis when markets are in a downtrend or volatile. And if things are just plugging along, there isn't a whole lot of volatility, then I'd like to sell calls maybe 1 strike or 2 strikes above, so I have the potential to make money on the stock, which actually really helps in that situation, boost the profit potential. On the option premium, we see here 30% ROI. And if there is 100% ROI, I'll consider a higher strike price. On the exit side, real quick, 90% max profit up until Friday. So if I could sell a put for $1 and I could close it for 10 cents up until Friday, I'll do that. So I could reload, take the trade again. If the option still has enough premium where I can't do that on Friday's expiration, then I'm either going to get assigned or I'll let it expire. If there's a 1-day trade where I could get that 80% max profit in a single day, I'll do that. And that works for both puts and calls. I'll also consider closing the entire position if I could get 90% of the max profit potential to move on. I like to manage 5 to 6 positions. And this is where I will roll calls out if I get 60% annualized. I'll roll calls up if I'm bullish the stock and there's a potential profit at a higher strike. I don't roll puts. With my style of trading and with the wheel, the goal is really to get assigned. I want to get assigned. And so I'm not rolling puts. Rolling puts to me is defensive. And if the stock gets below my strike that I've sold, I'm offensive. I believe that now is an opportunity to make money, so I don't roll puts. And as a general rule of thumb, sell puts on down days, sell calls on up days. I don't trade when I'm sick or distracted. And if I make a mistake, I liquidate. I'm done. I close the trade and I move on. So this is the wheel strategy in a nutshell. This is my trading plan. My trading plan is not following this guy. Here, Marcus likes his baby pictures, probably because he remembers these guys from a broker that is not as great as Tradier. We love Trader. I mean, actually, right now, Tradier is the only broker we support in the PowerX Optimizer software, which makes it really nice because we could actually trade directly through the software using Tradier's brokerage or platform. If you want to listen to the wheel strategy as an audiobook, it's pretty cool because when you access the audiobook, it will actually send you charts and all sorts of examples. So we wanted to make sure that that was available to everybody here for free if you are interested. So in a nutshell, that's the wheel strategy. That's how we trade it. And it's a great strategy for income and one of our core strategies here at Rockwell Trading.